Hello again, everyone. John Flynn here from Flynn Real Estate, serving Southern Ontario, based out of the Niagara region. Thank you all for tuning in again and watching. This week, I'm going to talk about 4 different things: industry professionals and how they endlessly pump up the market. I'm going to talk about affordability and where we're at now with regards to that. Some early bank sale info and statistics from 4 areas I didn't touch on last week: Winnipeg, Nova Scotia, and the tale of 2 other cities that I want to compare and contrast and talk about those stats too. So I just wanted to start with an email I received last week with a top realtor. He's promoting a seminar where he has guest speakers for industry professionals. He probably wants more agents joining his team or whatnot. I'm guessing that's the goal of it. But one of the mortgage brokers included in this, again, not mentioning any names. I don't like to call people out by names on here, especially people that I may have to deal with in the future. It doesn't help me and doesn't help my clients. But I just wanted to point out that there is this industry, or these industry tricks and tools that sometimes they promote and they use. And this is very clear on the email that I got. And what his title or his title of his subjects are, his topics are: creating urgency with mortgage rule changes, get your buyers to buy now. So I don't think that that's a good reason to get your buyers to buy, is by creating an urgency when there's a mortgage rule change. Maybe I'm misunderstanding the title, but it's very clear to me and very plain. Buyers should be buying for the reasons they see fit, not because someone has created urgency in their mind, or a so-called professional has. Anyway, I just wanted to point that out, that, there is some merit to some of those comments. Not all realtors and mortgage brokers operate like this. Most are probably more opportunists, where they sit and of course they're gonna sell homes in a good market. Others go a little bit further to push home sales, regardless if they think it's the right thing or not for that individual. And others look at the bigger picture and don't promote sales when they're not needed. Which brings us to our next subject, which is mortgage rates and mortgage payments, or affordability, I should say. And I wanted to compare February 2022 to February this year, just to see how those payments have changed. Has it got any more affordable? Of course, it hasn't got more affordable. It's less affordable. It costs more to carry a house. So let's look at these numbers here. These payments are based off the average prices in Canada for February last year compared to this year. This year I had to estimate because the numbers aren't out yet for February from CREA. So we're going to use 640, which is about a 5% or a little less than 5% over January. And most places have gone up, in that 5% range for February. It's been a pretty good month. Looking at February 2022, based on a $816,000 average price with 20% down, you would have a mortgage of $680,000. 2.8% at a 5-year fixed rate. And these are all big banks. I'm comparing big banks last year to big bank rates this year. I'm not going to compare the best rates to the best rates, because you can go to alternate lenders. These are big bank rates. Your monthly payment last year would have been $3,148. Let's compare to this year: an average price of $640,000, which would give you a mortgage of $533 with 20% down. 5.5% at a 5-year fixed. You're just over $100 more, $3,200 a month. So it's very clear, even with fixed rates, the payments have gone up this year. Let's look at the variables and see how that looks. 2022, on the average price with 20% down, $680,000 mortgage for a variable rate at about 1.5% last February, just over $2,700, $2,719. And this year, with a variable rate of 6.7%, you're at almost $1,000 more, $3,665. So no matter how you look at it, it's a lot less affordable this year than it was last year. And I bring this up because there's a lot of talk about, in the news especially, like the market is recovering. And I say we haven't even crashed yet. Like the prices or the affordability is still as bad as it was last year, and they're talking about a recovery. So what's the recovery going to be? Our affordability is going to get even worse. But anyway, let's look at some bank sales. I have some preliminary early bank sale statistics from my MLS system that I have access to. For those of you who know, it's ITSO, the surrounding GTA. And I started tracking them every 2 to 3 weeks this year, just to see the number of them on the system and kind of, where they're coming from. So as you can see, they have been increasing. Not a lot of data so far, and not a ton of bank sales by any means. But again, I thought it was wise to start tracking them every 2 to 3 weeks and see where they're going. I'm guessing they're going to keep continuing in an upward trend. But again, I'll keep an eye on this and see where it goes. And here they are broken down by the different types of lenders. We have big six banks and we have alternative or private lenders. And as you can see, the alternative or private lenders, and actually the private lenders make up the majority of that slice of the pie. They have, the majority of these bank sales. I remember after 2008, the majority of the sales I saw coming through were either big banks or places like Home Trust, which were alternate lenders, but they were big lending institutions or mortgage institutions. And looking further at the data from the big banks, you can see which banks have more bank sales right now. So again, this is early numbers, very preliminary, not a lot of data there. So take it with a grain of salt, but I will continue to track this information. Okay, so I've had a request for just a couple of cities, but stay tuned for this because these cities are kind of going in opposite directions. Let's start with Cambridge. So I've included the March numbers in this data. It's the last green bar on the right. Obviously, we're only this was 12 days in when I did this data. And in Cambridge, they're down 27.8% from the February peak, 290,000, down 3.8% January to February, which is the full months of data we have, which is about 30,000, and down 6.9% from February to so far into March, or $52,000. Now, this data was pretty interesting because most places or many places have had very good Februarys and had big increases over January. And of course, looking at this data, you can see it's the opposite. The cumulative days on market has significantly dropped in March so far, and it's come down every month this year so far. Months of supply is very low in Cambridge. We're at 1.2 months of supply, which is very, very low. They're very low in supply there. And of course, the number of sales has significantly increased in the last couple of months. So in Cambridge, we have increasing but still very low months of supply. Sales are increasing, but prices are going down. So kind of an odd dynamic there. Let's compare that to St. Catharines, which was another place I had requested. So you can see in St. Catharines this year, the last three green bars on the right side has been going up. They're down 22.5% from the peak last year, 180,000. They're up 4.9% from January to February this year, and another 4.4% from February to March, or the balance of March so far, which is about $27,000. Cumulative days on market has dropped from the January high. Months of supply, a lot higher than in Cambridge. It's almost at 2.5 months, and the sales have significantly increased from the previous month. So it just goes to show you from area to area, things are different. Anyway, let's move on to Winnipeg. MLS inventory in February was higher than the previous pandemic Februarys of 2021 and 2022. While MLS sales were lower than the record Februarys of the same time frame, notably this February is the 8th consecutive month that the inventory was higher than the same month in previous year after inventory started to rebound in June 2022. So sales are down and inventory is increasing. And here is that statement pretty much summed up in a chart. You can see this February is significantly lower than last February, and same with January. Moving on to average prices, looks like they've crept up there month over month, $8,000. They're down 17.4% from the May peak, or $79,000, and they're down 12.6% year over year for February, or $55,000. Winnipeg attached home prices, they're down 8.1% from the April peak, $30,000. They're up 3.3% month over month, or 11,000, and not much change from last February. And condos are down 9% from the June peak, or 25,000. They're up almost 10% month over month, $22,000, and they're down 4.5% from February last year. So some interesting movements in Winnipeg. Again, it looks like that little to gain, little to lose compared to other places like Ontario and BC, but interesting stats nonetheless. And lastly, we have Nova Scotia. MLS home sales in Nova Scotia remain soft during the month of February. Looking at the sales chart for February, well below the 10-year average. New listings are even further below the 10-year average. And active listings higher than 2022 for February, about the same as 2021. So looks like still a very low inventory situation in Nova Scotia. Looking at the average sale price, it's down 12% from the March peak, or $55,000. up 6.5% month over month from January to February, or 25,000, and down 11% year over year from last February, or 50,000. So that's the data for this week. There's been a lot going on in the markets this week. There's been bank failures and all sorts of things. Next week, I'll have the national stats for Canada. So we'll analyze those numbers and see where we're at. And I will revisit some of my predictions or my indicators to see where we are in the market and where we will be going based on those indicators. Thanks for watching as always, and I'll see you next time.